Welcome to another edition of Taking Stock for the week ending the 11th of July, 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. How are you today?
I'm doing much better. It's been a bit of a hellish week in the Swartz household with everybody going down with the flu, but I'm bouncing back today. So nice to be joining you again.
Yeah, great to hear, Matt. The weather is certainly cold this winter, and I'm lucky I've avoided it for the time being. But just before we get started, just a quick yet important reminder: the information we provide today is of a generic nature and shouldn't be considered personal advice. Remember, shares are volatile, so past performance figures aren't a reliable indicator of future performance. Well, Matt, quite a choppy week for equity markets, with investor sentiment rocked by renewed trade tensions out of Washington. US President Donald Trump did announce plans to impose a 50% tariff on copper imports, a move aimed squarely at China's dominance in global refining and also to encourage domestic US production. While Australia's exports of copper to the US are quite limited, the implications for major miners like BHP and Rio Tinto, both with stakes in Chile's massive Escondida mine, are being closely watched.
Yeah, Ken, it's genuinely difficult to follow the logic behind this development. And my guess is that investors are ignoring Trump's predictable rhetoric and chest beating on trade and obviously expect that this is simply just posturing for future trade concessions. Trump has also flagged tariffs of up to 200% on pharmaceutical imports, albeit there appears to be about an 18-month grace period for companies to make the appropriate supply chain adjustments. This is again genuinely hard to fathom, given that companies like CSL provide life-saving therapies and vaccines. But nonetheless, it will have repercussions for many biotech pharma companies, including CSL, who do export plasma-based therapies to the United States. CSL is lobbying for exemptions, but the uncertainty is already weighing on confidence in the sector.
Yeah, definitely, Matt. And back home, you had the RBA. They surprised markets by holding interest rates steady at 3.85%, despite overwhelming expectations for a cut. And this marks a shift in tone from the RBA, with Governor Michelle Bullock saying that the board wants more clarity on the second quarter inflation and employment data before easing further.
Albeit though, Ken, the message was pretty clear. The direction of rates is down, but it is cautious. This unexpected decision caught some economists and traders off guard, with only 4 out of the 36 economists correctly predicting a pause. At the stock level, not surprisingly, the REITs did underperform.
Yeah, however, I noticed the bank stocks, they got a short-term boost as their net interest margins, which tend to hold up when you've got steady interest rates as well. But let's now turn our attention to some star stock highlights in recent weeks, starting off with the medical imaging software provider and star growth stock, Pro Medicus, a long-time holding in our star stock portfolio. It's not every day you see a business with over 50% net profit margins. How does Pro Medicus manage this?
It's the gift that keeps giving, isn't it, Ken? Look, with regards to the incredible margin, it really comes down to the strength of their product and scale. Pro Medicus provides imaging software to major hospitals through its Visage platform. And once that's integrated, these systems are incredibly sticky. And because it's cloud-based and highly scalable, each new customer adds substantial margin with minimal extra costs. That's what drives those elite profit margins and return on equity above 50%.
Yeah, quite incredible there, Matt. The company recently announced two significant US contract wins as well: 170 million 10-year deal with UC Health in Colorado, and also a 20 million 5-year renewal with Franciscan Health. Now, that's about 190 million in total contract value, which is substantial considering that PME, Pro Medicus, they reported just over 160 million in revenue for financial year 24.
They just keep winning contracts and they need to, but it is testament to the quality of the underlying product. And these contracts will meaningfully add to the recurring revenue over time. Based on its contract size, that's an extra 10 to 12% in incremental annual revenue. And given its margin profile, a large portion of this flows directly through to the bottom line.
Yeah, fantastic there, Matt. And with the contract wins like these and a solid pipeline of opportunities ahead, it's no wonder the market is paying such a large PE multiple for this stock. But now moving to another software provider, Stargrowth Stock, RPMGlobal, a mining software company that saw a strong share price reaction this week. What's behind the rally, Matt?
Well, the company reported a record 100.8 million in software contracts for FY25, which is a 31% jump from the prior year. And importantly, the vast majority of this was subscription-based rather than one-off licenses, which adds greater predictability to its future earnings.
Yeah, that shift in revenue mix is great, but it's worth noting that the return on equity is forecast to fall from 16% to 12% this year. That's largely due to this divestment of their advisory business, which has increased the equity base significantly.
And another factor to consider for members at home is the limited analyst coverage. Only two analysts currently cover the stock, meaning consensus numbers could be less reliable and subject to greater uncertainty.
Yeah, that's right, Matt. And now moving from mining services to the miners, gold producer Northern Star, the gold miner has come under pressure following a string of negative earnings revisions despite elevated gold prices. What's behind this move?
Look, it's a volatile old world in the gold mining space, isn't it, Kien? But
Mm.
specific to Northern Star, the negative revisions stem from several key developments. First, at the end of April, the company did downgrade its FY25 production guidance by about 5%. This followed a weaker than expected March quarter, driven by delayed access to high-grade ore at its Golden Pike North mine and high maintenance costs at its Yandal operations. At the same time, Northern Star also raised its all-in sustaining costs guidance by around 9%, so a double whammy there.
Yeah, and the market is also digesting the recently announced acquisition of that De Grey Mining as well, a financially weak business. While the deal may provide a long-term upside, in the near term, it's expected to dilute Northern Star's earnings per share from financial year 25 to financial year 30, adding to investor caution here.
Adding fuel to the fire again, Kien Northern Star's update this week flagged rising cost pressures into FY26 with guidance coming in a whopping 17% ahead of consensus estimates. Management did cite sector-wide inflation, higher capital requirements for its underground processing infrastructure, and increased royalties as gold prices push higher.
Yeah, quite a lot of risk there, Matt. We're closely monitoring these risks, but note that despite the downgrades, though, the market still anticipates return on invested capital to rise to around 21% this financial year. So investors may wish to move across to some of our other gold exposures if you're not comfortable with some of these risks, though. In Under the Microscope this week, we drill into Netwealth Group, one of the top performing investment platform providers in Australia and a long-standing star growth stock. Netwealth, they just wrapped up their financial year with strong funds under administration growth. So, Matt, the company consistently delivers strong return on equity forecasts at around 71% in financial year 25, and also industry-leading margins here. What's the secret behind the profitability?
Well, look, we think there are a few structural and strategic advantages behind these numbers, Ken. First, Netwealth operates in an asset-light platform business, which requires minimal capital requirements. That means a good chunk of revenue drops straight through to the bottom line. And second, the revenue model is highly recurring. Around 95% of revenues come from platform and investment fees.
Yeah, very high stakes there. But I noticed from the announcements this week in their fourth quarter update, it was interesting to see that their funds under administration that still met expectations, even though their quarterly inflows were lower than expected. Net flows came in at around 3.8 billion, which was short of the 4.4 billion consensus. How did they manage this?
Strong markets can. It really does come down to the uplift in asset prices. And while net flows were below expectations, a little disappointing, Netwealth did see around 9 billion in market gains during the quarter, which helped total funds under admin finish at about 113 billion, which was bang in line with consensus.
Yeah, definitely. Net wealth is tied to market movements quite closely there, but hopefully this won't impact their earnings revisions. What's reassuring though is that the advisor transitions and new business across all segments, retail, high net wealth, and also institutional, they all remain quite strong, but still at a price to earnings multiple of 70 times. Some investors are wondering if this stock is priced for perfection. So is net wealth overvalued?
Look, it's a good question. It's an eye-watering multiple. on a headline basis, but the multiple is steep, but can quickly come down over time if the business can continue to sustain and generate the double-digit earnings growth rates forecast for the next few years. Historically, growth stocks do trade at high multiples. That's because the value of the business is based on future expected growth. We see this as a very high quality play and a disruptor in the investments platform space. And we believe, obviously, as Tim always says, you need to pay or be prepared to pay a premium for quality companies. But the risk is, obviously, if growth does slow or market sentiment turns, the valuation would most likely compress. And this will represent opportunity, in our belief, for long-term investors.
Yeah, thanks, Matt. And it's great to see that the founders, the father and son, Matt and Michael Haynes, they continue to lead the company with their strategic direction while holding close to a 50% stake in the business, aligning their interests to shareholders. We currently have 3 wealth management platform providers within our Style Growth stock universe. So a good question that is often asked among our members is, what is the difference between Netwealth, HUB24 and Praemium?
Yeah, it's a good question. And to be answered, you can simply use the peer comparison table at the bottom of our 9 Golden Rules page. You can compare all these 3 stocks quite simply. The obvious distinction is that Netwealth does have a much higher ROE and net profit margin than the other 2 competitors at 72% and 36% respectively. Now, the reason is because Netwealth focuses on a highly scalable platform product and has built a large client and advisor base, so its fixed costs are spread across more clients. Also, Netwealth's revenue is heavily skewed to recurring administration and platform fees, which are higher margin than transaction-based or third-party services. So currently, Netwealth does have a market share of 6.5%, so there is plenty of room for growth.
Yeah, thanks, Matt. And in comparison, HUB24, they earn revenue from multiple sources, including portfolio administration and superannuation. Not too long ago, they did acquire Class. All this can involve more operational costs and regulatory capital. Hence, they operate at lower margins. They also offer more flexibility and control, especially for dealer groups and professional wealth managers, including having extensive model portfolio functionality and customization with other tools as well. Now, HUB's market share is close behind Netwealth at around 5.6%.
Yeah, look, that's helpful, Kien, in getting an understanding of why the capital efficiency measures are different. There are some obvious verticals that are quite different across the businesses, so that's quite helpful. Now, for Praemium, they also focus on more complex, sophisticated portfolios for advisors who need non-custodial reporting. That's where their clients hold assets outside of the platform, but still want it all consolidated into that one report. It has a strong expertise in SMAs, otherwise known as separately managed accounts, hence why it incurs higher costs, which lead to lower profit margins than the likes of a Netwealth. But currently, Praemium commands a market share of less than 2%, hence why it hasn't reached that scale to trade at a high multiple than the other 2, so it does trade at the lower valuation multiple.
Yeah, regardless, Matt, they all are high-quality businesses and have continued to chip away at the dominance of incumbent platform operators like the Big Four banks and also AMP, who still collectively control the majority of legacy retail super and investment flows. So the market opportunity here remains quite strong. But that's all we have time for today, Matt. Thanks for your contributions, and I'm glad you feel much better this week.
No, my pleasure, and I'm glad I'm feeling a whole lot better towards the end of the week. And if you do have any questions, please feel free to join us at Lincoln Live on Monday morning.
And just a reminder as well, with reporting season fast approaching, ensure you clean out your portfolios, focus on those financially healthy businesses, remain diversified, and have some cash to take advantage of opportunities as volatility emerges. Take care and have a happy, healthy, and prosperous week ahead.